Welcome back, guys. Today I'm talking about the stock market. I know a lot of people have thought the stock market was crashing last week. We see how wrong or right they were now. Regardless, we know volatility spiked a lot, so people are getting fearful. In fact, the fear index is, I think, at 40 right now, which is pretty high. And what's good for that is it increases premium. So, as an option seller, we love this environment, but we still got to be careful because people are fearful for a reason. When IV spikes, there's a reason. So, don't go too crazy. Now, what I'm going to be talking about in this video is my view of the stock market, what might be going on right now since we're in December, what I'm going to be doing with my portfolio to try to reduce risk while taking advantage of the volatility, and then just talk about just general ways to reduce your risk and maybe some tax loss harvesting kind of the tricks that you can do. So first off, looking at the NASDAQ, going back 2 years, you can see the NASDAQ was sitting at 9,000. Now it's up to 15,500. What is that, like a 50, 60% increase? Like the NASDAQ really shot off. We know that a lot of that was due to some larger technology companies carrying the weight, but overall, it's created a lot of P ratios that are pretty high. And I kind of just feel like those stocks are pretty overextended. And I think the money is going to be to look at the smaller cap stocks and figure out ones in there that you like to take advantage of. Because if you look at like the Russell 2000, which is the small caps, you can see it started off at 1750. It's only at 2200, so it's only ran up a little bit in those 2 years. Nothing compared to the Nasdaq. So I think there's just a lot more room for the small cap stocks to go up moving forward. So look for those smaller cap stocks that you like the company and that you want to play in. Uh, Going into the stock market, so there's like three things that you can do to kind of reduce the risk when you're selling all these options. And one is to trade small. I always try to preach this. I may not always follow it. Sometimes it's tough to not be greedy or think that you're making a play that is a sure thing and put more on than you should. But really, stick to doing smaller trades, 3 to 5% of your portfolio. Look at that notational value. I'm trying to incorporate that more into my own trading myself. The other thing is to spread your shots. Don't do everything on the same underline. Put them on multiple underlines. Let the numbers work in your favor. You gotta spread your shots out like that. The other thing you do is you should, in order to reduce volatility in your portfolio, is to try to put on both bearish and bullish positions. So that if the market does decide to trend down, maybe your bearish positions are making you money to offset the losses, and vice versa. If you're wrong on a bearish position, all your bullish plays are kind of canceling out those losses, and you can lock in those gains along the way and just reopening as the market moves up and down. So something I've been looking at for my portfolio is to add some more bearish positions. I have an easy time putting on bullish positions because stocks always go up, right? But putting on bearish positions for me, it's a little harder for me to find entry points that I like or plays I like to put on, and so that's something I've been trying to do more of. And I'm gonna go ahead and show you some of the ones I've put on recently. Let me get rid of that there. And so recently, or actually today, I put on two new ones. And one of those is actually an Apple Bear Zebra. And this is a play where you try to make a zero extrinsic trade so that theta is not eating away at you. And basically what happens is if Apple dips below 175, for every dollar it goes below 175, I make about $100. And it only cost me $18.50 to secure this position. Instead of shorting the stock, my max loss, if everything goes completely south against me, is only $1,850. Now, if I was shorting the stock, obviously my downside would be unlimited because Apple could go to infinity. So that's why I like the Bear Zebra play. I'll put a link in the video above here. And the other thing I put on was a Snow Bear put spread. And what I did was I bought the 365, I sold the 350. So my max gain would be if Snow went down below 350, then I collect the best premium that I could. And it cost me $655 to put on. My max gain would be the difference between the spreads minus my cost to enter this trade, because this is not a theta play. This is a Vega play. And so the spread is 15 wide, so my max gain would be 1500 minus the 655. So was that like 950 or so? And I think that's pretty good. Like I make more than 1-to-1 on my money if it gets breached completely. So that's kind of what I'm looking at on that one. If we want to look at the charts for Apple, I'm looking at putting that on. I believe in Apple long term, but I just think it's a little overextended right now. So that play for the Zebra has 45 days. So if Apple dips below 175 or 176 in the next 45 days, I'll make money off that play. and I'll get out of it pretty quickly. Like if Apple dips down to 155, I'm closing out for my $1,000 gain and getting out of Dodge. Like I wanted to make sure that this was done before earnings, so my play does end. I think it was January 14th was the play I put on, so it ends before earnings. Uh, it shouldn't be affected by any kind of volatility increase or decrease because it's a zero extrinsic play. In fact, I think an increase in volatility might even help me slightly, but it'd be insignificant because it's a zebra. And basically, it's just when Apple makes a run up like this, and you see it go up above the RSI here, pretty high, like the 75 range or above that, it really quickly like dips down immediately after. Here we go, another one, RSI up, dip, RSI up, dip, RSI up. Well, here we didn't really get a big dip, but it did dip within a month or two there. So I got 45 days. I think we're going to see the same thing, a small dip. Will Apple go up after that? Sure, but I'm expecting a small dip in the short term, and then it could take off, it could go down. I don't care because I'll be out of the play by then. So that's why I put on a zebra on Apple at this play here. Snow, I just think, again, I'm looking at the charts here. It's gone up, it's gone down. I think it's worth less than it currently is at, which is why I did the bull or the bear put spread. And I just expect a small dip. When it does, I'll close the position. If it doesn't, then at least my max risk is defined by the debit I pay to get in. So I'm only risking, what was it, $650 on that play. Pull that up and take a look again, just so I don't lie on YouTube. Yeah, $655. That's the most I can lose on that play if I'm wrong. So if the stock goes down, I make money. If it's up, that's the most I can lose. And I got until January 14th on this one too. Something else I've been doing is I've been trying some different trading strategies of some shorter dated contracts where I read the charts and try to make a quick play here and there. And today I did do that in Tesla. I bought a bull put spread. And then within a minute, I was able to close it for a $50 gain. Had I held it, I probably would have made $450 off this. But since it's a new trade strategy I'm trying out, I didn't want to hold it for long term and have it go against me. My max risk on this was 486. Because again, similar to the snow play, the debit I paid to enter the position is the most I can lose. But since I'm not used to using closer to zero dated contracts, like I see theta, like that's a lot of theta that's gonna go away in 2 days. So like I was just a little nervous to hold on to it. So that's why I closed that one early. Something else I want to talk about is like some plays that I want to look at for like moving forward. Like right now, we had that spike down. I think there's a meeting next week that there could be a lot of volatility and stocks could drop quite a bit. And if it does, like I think the play to look for is to look for leaps to buy. Just like in March 2020, if you bought leaps, even at the peak before everything went down, and you held it till right now, you're up significantly. Like in the money leaps are amazing. So what you want to do is look for stocks that you actually like that are trading at a discount. So like for me, something I do like would be Virgin Galactic at this price. Like it's trading at 1564. If we switch to Thinkorswim and take a look at that, you can see 2 years, the low is 786, so that's kind of bad, but a lot of the volume happens around 18, 15, like we're at pretty good lows, not quite 2-year lows, but going back to April 420, like the low is 16, so we're below that area. I think that's a good time to start playing Virgin Galactic again. Now, I have some puts in place. I really don't want to be getting more exposure to that stock. If I did not have puts that are in the money on Virgin Galactic, then I would be looking to buy leaps at this point, because all it takes is a little bit of news, and you just see like Virgin Galactic pops, and it pops hard quite a bit, even on very little news. And I think it's just going to continue to be a pattern for it. So like this is a time to load up if you want to, but again, trade small, look at that notational value, and make sure you're not putting too much into one bucket here. So for me, even though like I really want to do a lot of Virgin Galactic, I'm gonna hold off because I do have 3 puts right now that are in the money, and those I'm gonna be planning on doing the wheel. And maybe next week you see me make a video about managing a flat wheel because my puts were at 22 and we're trading at 15. So how can you make money on the wheel when you're down significantly on the stock? And I'll show you that next week probably, unless Virgin Galactic pops up this week. Who knows? But basically, what I'm trying to say is like look for stocks that you like that are trading at a discount and buy it up. Buy some leaps. Use that leverage to your advantage. If they're at like 52-week lows, take advantage of it. Anything else in here that looks good? I love Palantir, so I'll be eyeing this one, although I think it has room to drop right now. So I'm going to wait, see if this drops back down to 18, maybe 17.50, and then you might see me buy some leaps on it. Poor AT&T. Who would have thought at this point it'd be down to 23 or below 23 and we wouldn't be gobbling it up? I hate that they cut their dividend. Yeah. So anyway, that's just what I would suggest: is find stocks that you want, that you believe in long term. Buy those 2-year leaps and make sure that they're deep in the money so that you take the full advantage of simulating that you own the 100 shares, and just hold it and be patient, because obviously the stock market is all about patience. What's that quote? The stock market is a vehicle to transfer money from the impatient to the patient. If you like this video, go ahead, like, subscribe. If you want to learn more about the zebra or the bull puts, I'll put the videos to the left here. Go ahead and click on that. And good luck trading tomorrow, guys.